Good afternoon. Welcome to today's webinar on the spring statement. So just waiting for a few more people to join in before we start diving in. I think the numbers are shooting up quite a lot, quite quickly. Got a lot to talk about, I think, today in terms of what's happening with the spring statement. I think there's a few reminders in terms of what's going on with the autumn announcements, things that come into play in April. So just wait for a few more people to come on and then we'll get cracking. Right. Okay, it's very exciting seeing the numbers go up. Right. So just to introduce myself, my name's Marie Pegram and I'm a regional managing partner at TC Group, and I'll be your host for today's webinar. And I'm delighted to be joined by Wendy McGarvey, who's our head of HR, Felix Med, who's our head of R&D, and Graham Bohr, who's one of our tax partners. So the spring statement, I think the prime focus was growth tomorrow, and whether this is going to be achieved, I think, is the million-dollar question. We'll try not to go into any political talk today, and we'll keep it purely on tax and HR. But I think there's expected growth in 2025 has been halved, according to OBR, so it's half from 2% to 1%, but that's higher than subsequent years owing to the government's house building programme. But much of this, in terms of it being halved, has been based on factors outside the government's control. So it's been pressure on defence spending and increase in global trade restrictions. And there was mention about Rachel Reeves' headroom of that 9.9 billion against the target. And I think with what's happening with the US in terms of Trump imposing some tariffs, which we're going to find out more information on that on the 2nd of April, day after April Fool's Day, next week, and to see what impact that's going to have. But that could have quite a considerable impact on the UK economy, and that could wipe out this headroom that Rachel Reeves has put in place, and this may have an impact, and I think knock-on effect when the autumn statement's released at the end of the year in terms of what happens with our taxes. Inflation is expected to average about 3.2% this year, according to the Office for Budget Responsibilities at OBR, before falling back to 2.1% in 2026 and 2% in 2027. So the government target is 2%, but it's good news that it is falling. And in terms of the US and EU countries, they're also looking to limit their price increases. So the inflation rate for those countries using the euro is at 2.3% in February 2025, and that's down from 2.5% in January. And inflation in the US is also fallen from to 2.8% in February, which is down from 3%. So it's good news in terms of inflation side of things, but I think it's still quite a tough economy for a lot of business owners. And I think that's where our experts come into play today, to talk about how the impact of the statement and the taxes and HR is going to impact you and your business. But before we dive in, I'm just going to say, please feel free to ask questions using the Q&A function. And if you want a clarification at any points or anything, we'll try and get around to answering all these questions during the webinar. But if we don't get around to them, I'm sure we'll be able to follow up afterwards as well. And we will be recording this webinar, so should you wish to recap on any of the points, you can do that as well. But I'm now going to hand over to our tax expert, Graham Bohr, who's going to talk through some of the tax aspects of the spring statement. So over to you, Graham.
Yeah, thanks, Marie. If you were watching the statement live yesterday, Rachel Reeves quite early on said she's not going to be making tax announcements. It's one fiscal event per year, and that's the autumn budget. And in terms of what was said yesterday, she stuck to that. There were no sort of verbal tax announcements. Off the back of the speech, we did go onto the gov.uk and have a look at the documents, and there are a few things in there related to tax. So what we're going to cover from a tax perspective today, a sort of spattering of new things that came out of yesterday's announcement and the documents alongside it. Then we're going to have a look back at some of the things that were announced previously, so maybe at the autumn budget last year, but which take effect in a couple of weeks' time when we get to the start of the new tax year. So most of what was spoken, or most of what was released yesterday, we've called it tax avoidance clampdown, whether you want to call that narrowing the tax gap, but really around trying to bring some more money in rather than new policies or new taxes per se. So put some of these on the screen there, 500 more compliance officers. That's quite a big thing to announce at a time when we're looking at 15% budget cuts across the civil service, to be taking on 500 new staff. Maybe wait and see whether they turn up, wait and see whether they're any good. That said, if you look at compliance officers in the revenue, they do tend to pay for themselves because they tend to be out there looking in taxpayers, asking questions, getting underneath the bonnet, and generally, if they're any good at their job, bringing in more than they cost. So potentially quite effective. We've got increased use of AI and better use of mass third-party data. So third-party data, this is something the revenue get a lot of from various places. We've got Common Reporting Standard, which is international exchange of information. And they get a lot of data from banks, from insurance companies, online platforms like Vinted and eBay and Airbnb and all of these places, even Amazon and places like that. They are actually pretty good at using this data. So they have an IT system that's quite good at comparing information that they receive with taxpayer provided data, so tax returns and similar things, and looking for gaps and then being able to ask questions where those anomalies exist. The particular announcements yesterday were to do with getting information from providers of card payment systems. And that was all around trying to find people who are taking card payments who look like they are operating some sort of business and who the revenue don't have any record of them being in business. So trying to sort of identify these unregistered traders, in the revenue's words, to help them to make sure they get their tax compliance correct. It might be a little bit more aggressive than that, I suspect. Also around bank interest, interest rates obviously been increased for the last 2 or 3 years compared to the decade or so previously. The revenues figures, they think 2.5 million more taxpayers are going to be paying tax on their bank interest in 2028-29 than in 2022-23. That's a combination of those higher interest rates and kind of fiscal drag where tax allowances are frozen and specific savings allowances have actually been going down over the last year or two. And so they're looking at, getting this information from the banks, the building societies, the alternative finance providers, and just trying to make sure that not too much of that stuff is slipping under the radar. A bit of rhetoric as well. So let's have a 20% increase in prosecutions for tax evaders, tax fraud. There is actually quite a good reason that the revenue don't pursue a lot of tax prosecutions, and it's that they are difficult, they take a long time, they're expensive, and they don't tend to raise any money directly because prosecuting someone criminally, putting them in prison, maybe that doesn't raise any money, whereas a kind of civil enforcement process might be more successful and a bit easier. What we will see if they follow through on this, if you start seeing a few more tax prosecutions, does have quite a strong deterrent effect. So while they're not particularly effective in their own right, they do create that deterrent effect for other taxpayers. Marie's mentioned America a couple of times. You only have to look to America to how scared people are of the IRS, to see how that deterrent effect can work. We also got some new information about penalties yesterday, twofold. So there are some changes to penalties which are going to be taking effect in the new tax year. They relate to VAT and will relate to making tax digital users. And their increases, quite big increases really, in late payment penalties. We've got this much wider consultation that was launched yesterday about behavioural penalties. So Revenue use a system of behavioural penalties to deal with taxpayer non-compliance. They look at, has the taxpayer taken care? Have they been careless? Have they acted deliberately? Have they tried to conceal what they've done and then set the penalty levels accordingly? So we're looking at some more evolution on that penalty regime, some harmonisation across taxes, rather than individual taxes having their own regimes. And it's a bit of a watch this space, but it's fair to say that if you look at how much money the revenue collect in penalties over recent years compared to maybe 20 or 30 years ago, it's become a real income stream for them. So not a huge surprise to see them paying attention to that, but from a taxpayer's point of view, the importance of kind of getting things right, paying on time, knowing when those deadlines are, the downside of getting that wrong becoming just a bit more dramatic. Lastly, this idea of just helping, again in the revenue's words or the Treasury's words, helping these taxpayers be more compliant, reduce mistakes, increase compliance, help people get things right first time. So if we jump on to the next slide, we're going to have a look at making tax digital, which is the revenue's silver bullet to achieve taxpayer compliance. Now, I went and had a little look on the National Archives, which is where this graphic came from. Making tax digital, first announced December 2015 by David Gork. It was intended to have a launch by 2018, and by 2020 it was supposed to be in full swing. Since then, I had another look back. We've had 5 new prime ministers, 7 new chancellors, 3 general elections, 2 pilot projects, and no MTD filings as yet. So that downward graph from 10.2 million returns to having wiped them out, that didn't quite materialise, and it's actually gone the other way. We're between about 12 and 13 million taxpayers filing a tax return each year currently. Could we go on to the next slide, Marie? So during that period, it's had a real hard time. They've delayed the implementation to a new date, delayed the implementation to a new date, delayed the implementation without giving a new date, just went squarely into the long grass. It's been through Public Account Committee hearings. It's been slammed by a cross-party House of Lords committee. It's been criticised from pretty much every angle imaginable. But nonetheless, yesterday we got a document that said it is still coming in. We're still going ahead with it, and we still think this is the solution. Next slide, please, Marie. So we've had this April 2026 launch date for a little while. That's been confirmed in the paperwork that came out yesterday. This is going to apply to the self-employed and to people renting out property. And it's going to have a staggered start date. So people turning over at least 50,000 will be brought in from next April, 30,000 the year after, 20,000 the year after that. Those are individual thresholds, and they are sort of gross turnover thresholds, and they're also annual thresholds. So taking out seasonality, but if you're a married couple, for example, running rental properties, you're looking at each of your individual gross rent receipts, not your combined gross rent receipts. There's a whole host of exclusions. So partnerships have been a big problem. They're still currently going to be excluded. We've been told they will be brought within scope in due course, which I think means once they've worked out how to manage it. Digitally excluded people who have got an attorney acting for them, or trustees or executors, people who are Lloyd's underwriting, people who get married couples allowance, people who get blind person allowance. So anyone who's using the residence and remittance basis pages on their tax return, all these people are currently not going to be dragged into MTD, and really that's because the revenue can't quite work out how to make it work for them yet. The principle of MTD is the same. It is digital record keeping, quarterly filing of fairly basic cash in, cash out figures, quite a low bar. So although the revenue want these people to be quarterly filing, the information isn't going to be all that informative. It might be cash received, cash gone out, and we're not worrying about any of the adjustments that you might normally see for things like capital spend, accruals basis, kind of seasonality stuff, anything like that. That might all be caught up later. What was really surprising, disappointing, maybe both, the revenue did publish yesterday that if you're in Making Tax Digital, you are no longer going to be able to use the revenues free online tool for filing your taxes. So you are going to have software that does that, and the software you use is going to have to either be capable of filing all of your tax details or digitally linking to some other software that does. So for example, if you're providing records to us, doing that through a kind of digital link. So I think there's going to be a real flurry of activity around this over the next year as the software houses kind of finalize and go to market with what they're offering, as clients start to sort of adopt these systems, and as we are helping those clients know what they need to do, what we need to have from them to make sure we're keeping them compliant with the new system. Next slide, please, Marie.
Graham, just to ask before we go on to the next slide,
Yeah.
you mentioned quarterly filing. Does that mean there's going to be quarterly tax payments as well?
Not currently. So all of the focus has been around filing. There's no mention. Well, there's been explicit mention that it won't affect payments currently. I think it would be silly to think that in the fullness of time that won't follow. That seems fairly obvious that once this is up and running and people are filing quarterly, then changing the tax payment is the next logical step, but we're probably looking maybe 5 years down the line before we need to worry about that.
Might be longer, according to your graph earlier.
Well, yeah, if at all. So the other sort of big focus that came out of yesterday's talk, big increases in defence spending, and there was a lot in the Chancellor's speech about homegrown talent, homegrown technology, UK tech companies, and getting technological advances into the front line quickly, and also talk about improving access to government contracts for smaller companies. So probably fair to say it tends to be very large companies that win government contracts currently, but there's been a lot of talk over the last couple of years from Labour about tech companies and growth companies and rivaling Silicon Valley, and that being a real growth area for the country. And they seem now to have tied that to this increase in defence spend and giving access to maybe some of these slightly smaller, newer companies to be supplying the government and winning some of that work. But definitely some opportunities there for the types of companies that are, particularly tech startups, people who are maybe R&D heavy. So that's a neat little segue for Felix to talk to us a little bit about R&D and a couple of changes there from yesterday's talk.
Thanks very much, Graham. Yeah, so not many changes across the R&D scheme as was consistent with the budget. I think the key one, as Graham covered, is we're likely to see an increase in spend across the defence and defence adjacent sectors, precision engineering, potentially software as well. And R&D tax credits is going to continue to be an essential factor for supporting companies in those spaces. I think to tie that into the merge scheme, which is now firmly in place, one of the key things that's unlocked is a bit of clarity around subcontracted R&D and projects that have been subsidized, which has now been sort of almost removed, had the blockers on it removed. The key takeaway there in terms of subcontracted R&D is there's now been a bit more guidance provided, and companies that are undertaking R&D eligible projects under contract should probably be looking to speak to an advisor early on in the process just to make sure they're taking appropriate steps to ring fence and defend their right to claim R&D relief on such projects. I think the only other claim was a push from the government, or the only other change was a push from the government to increase uptake on the advanced assurance scheme. Without going into too much of a diatribe, this was a scheme that companies could opt to undertake an R&D inquiry at the front end of an R&D submission. And if they were successful, they would be free from any further compliance checks for the next 3 years. HMRC commented that there's been a low uptake on this, and I think they're keen to see more. But I think that's unlikely to happen, in all honesty, simply because those companies that are relatively confident in their ability to claim R&D tax are probably going to do so and say, if an inquiry crops up, we've got expert advisors will be able to address that. And therefore, why risk a guarantee, or why undergo a guaranteed one? And those companies that are probably thinking, R&D inquiries in the past have been quite onerous, are unlikely to be undertaking it in any case. So HMRC perhaps firmly hitting the gap in the market there. But yeah, if you qualify, why why would you guarantee yourself an inquiry? And if you don't, why would you undergo it? But nonetheless, those can be looked at if companies are curious on that front. And that's really all the changes or all the impacts on R&D relief at the current time.
Real, thanks, Felix. Just one question. Obviously, Graham mentioned there's going to be 500 more compliance officers that are going to come into with HMRC. Do you think there's going to be an increase in inquiries across the board for R&D claims?
Yeah, that's a great question, Marie. I think it's unlikely, in all honesty. We've seen a general trend in the last year or so of fewer and fewer of the more reliable companies, more reliable advisors in the space receiving mass inquiries, and those being saved for some of the more problematic advisors, shall we say. And I think that trend is unlikely to change. HMRC has broadly brought down the amount of error and fraud that they first identified in the sort of 2022 period. And with the merge scheme being brought in, I think they're contextually unlikely to want to ramp inquiries back up again. Europe, the US, Canada, they all have similar R&D investment schemes, and the UK definitely wants to make sure it's seen to be as an attractive destination for companies in the space. It could even be possible that the campaigns and projects team, which historically has been under secondment to investigate R&D claims, might be the source of some of those 500 new compliance officers that are being brought on board, and in fact that they're sort of tactically shuffled around, shall we say. So no likely changes to R&D compliance rates, at least from the signage at this stage.
That's good to hear. Okay, so we're now going to talk about the autumn budget. So there was quite a few big announcements that happened in October last year. Some of them that will impact businesses as of April next year. So I'm going to hand over to Wendy, who's going to talk through some of the really important HR announcements that will most likely impact your business. So over to you, Wendy.
Thanks, Marie. Okay, so the first one I'm going to talk through with you all is national insurance. So from the 6th of April this year, national insurance for employers is going to increase from 13.9% to 15%. Now, additional to that, the rate at which you will pay national insurance for each employee's salary, that will reduce from 9,100 to 5,000, resulting in an increased cost for business owners. Now, what this means in practice is that your payroll costs will increase by a minimum of £615 for every employee, and the additional cost for an employee on an average salary is nearly £1,000. For smaller employers, there is some light in the sense that your employment allowance is increasing from 5,000 to 10,500. So this change will cover some of those increased costs. Next slide, Marie.
Just a quick question on the employment allowance. I understand that you have to apply for it yourself, so it won't automatically be added onto your payroll. So if you do need to get the employment allowance, you need to apply for it. Is that correct? And is there any rules around it?
Yes, you do need to apply for it directly. I'm not sure on the rules around that scheme, but it's certainly something we can look at for our clients.
Yeah, I think my recommendation is speak to your payroll provider.
Yeah.
And they'll be able to make sure that whether it applies to your business or not. I'd also double check that we're coming to the end of the tax year now to check that you've claimed the employment allowance that's available for this tax year that's just about to end. Okay.
Okay, so the national living wage will be increased from £12 to £12.21 an hour from April, which will be a pay increase for over 3 million workers. For the 18 to 20-year-olds, the minimum wage will rise from £9.60 to £10 as part of the long-term plan to move towards a single adult rate. And then the rate for apprentices will rise from £6.40 an hour to £7.55 an hour. Thanks, Marie.
Thanks, Wendy. Just one quick question. If you were to hire an apprentice, how much will you need to pay them?
Okay, so for the first year of any registered apprenticeship, you can pay the employee the apprenticeship rate, which will be the £7.55 an hour. However, you can only do that for their first year of employment, and from their next year of employment, you must pay them at least the minimum age for the rate for their age. So as an example, if they're 21, you will then need to pay them the £12.21 as a minimum from then on.
Okay, thank you. And just one more question around the increase in employers' national insurance. Obviously, it's quite a hike for a lot of small business owners. You know, we're certainly feeling it in terms of our business as well. So with the increase, is there anything that you can try and do to make some cost savings?
Yeah, I think one of the things we've been talking to some of our clients about is looking at your pension scheme and how the employee contributions are deducted. If you sort of put them on a salary sacrifice basis, you'll pay less national insurance, so that impact therefore will be less for the employer. The salary that's sacrificed will not be subject to income tax or national insurance, which will actually then give the saving for the employer and also the employee.
Thanks, Wendy. I think one thing to add on that as well with the salary sacrifice is making sure that you don't go below the national minimum wage. That's got to be taken into account as well. But if you don't have employees that are on national minimum wage, this is a great way, I think, to save a bit of money, which I'm sure most people will welcome at this current climate. So now I'm going to hand over to Graham, who's going to talk through some of the tax changes that are coming into effect from April as well.
Yeah, thanks, Marie. There's been a whole lot of noise in the trade press, but also the real press, about the end of the non-dom regime for tax. Lots of people hoping it wasn't going to happen. Quite a big, anecdotally at least, quite a big exodus from the UK amongst some of the non-dom population, but the rules have been put into legislation. They come into effect in a couple of weeks' time, and domicile is going to stop being relevant when looking at tax status. This is sort of, you know, relatively niche. It's for your high net worth non-DOMs, but it's also affecting internationally mobile employees, particularly when you're looking at things like all the talk earlier about defence spend and high-skilled engineers and things like this, and attracting those people to the UK. They're all affected by these, what was the non-dom regime, what comes into being a long-term resident regime, and the foreign income and gains that sits alongside that. And it's also people who are maybe at the other end of life and thinking about retiring to the sun. Their tax shadow on leaving the UK is going to be looking a bit different, because they're going to be thinking about this long-term residence test rather than this concept of domicile, and just a slightly different way of going at it. There are some benefits available, so particularly people who are coming to the UK for the first time, or for the first time in a long time. If they've got overseas income, there are some opportunities there for them to enjoy some tax benefits in the early years of arrival. For non-DOMs who've been in this regime, who are staying here, there are potentially some opportunities to bring previously untaxed overseas income into the UK. And as I say, for people who are maybe thinking about retiring elsewhere, there's some thinking to be done in terms of how long is long-term for these new long-term residence rules. And that might be as long as 10 years that it takes to sort of escape the UK tax net. Might be quite a bit lower than that if you, depending on how long you've been here before you leave. So quite big changes, reasonably focused on people who are maybe an origin overseas or who are internationally mobile. Next slide, please, Marie. Perhaps of more immediate or more widespread relevance, some changes to capital gains tax. We've had an increase in rates that came in straight away on budget day, so the headline rates already went up last October, November time. But for business asset disposal relief, this is the favourable rate of capital gains tax for business owners who are selling that business or liquidating that business or winding it up. That's going in a couple of weeks' time from its current 10% rate up to 14%. And in another year, it's going from that 14% to 18%. So still a favourable rate of capital gains, but nowhere near as attractive as it used to be. It's £1 million lifetime limit. Once upon a time, that was a £10 million lifetime limit. So a sort of steady theme of this relief becoming less generous over time. There are still some opportunities around this. I mean, there may be some people hoping to get business transactions over the line before the end of the tax year. Maybe people who are thinking about doing something next tax year while it's still 14%. There's also a few kind of dovetails with owners of furnished holiday lets. So furnished holiday let businesses potentially able to enjoy this rate of tax, and there's a fairly limited window if you're winding up one of those businesses and getting rid of the property to maybe benefit from a better rate of capital gains tax while you still can. I think these rates are maybe also going to maybe promote a little bit more thought about the future of the business, whether a sale is the right idea. People might be looking more at successions of those businesses, maybe keeping them in the family a little longer. There might be some behavioural changes possibly. Can we have the next one, please, Marie? Stamp duty land tax. This is only in England, remember, so Wales and Scotland got their own regimes of tax. What we've got is some holidays coming to an end, so we've had a 0% rate of stamp duty up to £250,000 for residential properties. That's going to default back to 125,000. We've had some slightly more generous first-time buyer reliefs that have been up property values up to sort of £625,000 and a quite a high nil rate band. Again, those are going to fall back on in the new tax year to a £300,000 rate and a £500,000 transaction cap for first-time buyers. This sits alongside increases that have already happened to the rates of stamp duty land tax applying on second homes or on non-natural persons, so companies, trusts, things like that are buying properties. They've already had a sort of a penalised rate brought in. Also for non-residents, that rate's become a bit more penal as well. So a lot of talk yesterday about house building, about that being a real area the government think is going to help with growth and meeting those targets. Has to be said that stamp duty land tax is really quite a big consideration for anyone who's looking at a property transaction these days. It's become much more relevant than perhaps it used to be. Next slide, please, Marie.
I was just going to jump in here. I think stamp duty land tax seems to be getting more and more expensive.
Yeah.
I don't know if you've got any advice around that or thoughts.
It is, yeah. I mean, I'd almost say it's gone from being a sort of a bit of a nuisance or a bit of an inconvenience and afterthought to being a mainstay of tax planning now. Quite regularly, we'll have a client who's maybe asking us a question about property. They think they're asking a capital gains tax question, and when we give them our answer, quite often stamp duty is as big a part of the puzzle as the capital gains itself. So I think it's just thinking about stamp duty land tax that little bit earlier, because it is a little bit unusual. So for example, there's no spouse exemption in stamp duty. We're very used to there being a spouse exemption across most of our taxes. Inter-spouse transfers can face stamp duty land tax charges. Transactions with companies and residential properties in particular can be really, really punitive rates of tax. So if you're looking at land, maybe land that's sitting in the family, you're thinking about moving to develop that land, might be thinking about putting it into a company, just getting the timing of that right, doing it when the value is maybe not so high, maybe when the non-residential rates are applying. So just, I think all I can really say is think about that stamp duty land tax nice and early if you're thinking about doing something with property. Don't just get tunnel vision on capital gains tax. Do think about SDLT as well.
Thanks, Graham.
Inheritance tax.
Big guy.
Yeah, I got all the good news. Nil rate ban, that's your tax-free allowance frozen until 2030. That's going to have been frozen for 20 years. Last time that went up was in April 2010. We've all heard the phrase fiscal drag. That's been in the news quite a bit over the last few years in relation to income tax. It's having a huge effect on inheritance tax in terms of taking people who would never have thought they had an IHT problem. House values are going up and tax-free allowances are not going up. So another extension to that freeze. I think I'm right in saying that's now beyond the end of the current Parliament. So another 5 years of no growth in that tax-free allowance. Agricultural relief and business relief, these are reliefs from inheritance tax. They've been shelters for business owners, for farmers. They were capped at the budget. They're intended to come into effect in April 2026. The farmers in particular have been up in arms about this. Been a huge amount of lobbying, huge amount of protesting, huge amount of press focus. on it, but no signs that the government are planning on backing down. It's not a sort of total removal of the relief. We're going to have £1 million cap, and that's £1 million cap at 100% relief, and there's still going to be 50% relief beyond that £1 million. So not a total disaster, but it's going to really shake up the planning landscape. I think we're seeing a lot of questions from clients in these areas, lots of thinking about, rethinking plans. People who are maybe sitting on a business thinking this has got tax relief, it's got this tax favoured status, and I don't need to do anything much, suddenly having to think, well, actually, do I need to change my will? Do we need to start thinking about lifetime succession? Have we got the right business owners? Is a trust needed to try and help with this succession process? And lots of questions like that. There are going to be some sort of fairly simple wins. So the £1 million cap is per person. So, for example, a married couple, if they're clever, they can have 2 million between them. If they're not clever, they could waste one of those £1 million allowances, especially if you've got a will that leaves everything to the surviving spouse, especially if all those assets are pooled in the hands of just one of that married couple. There are some more nuanced planning opportunities they're going to be involving. As I say, can we introduce a trust? Does that help? Do we need to start thinking about generational succession, and can that help? How does this interplay with capital gains tax and so on? It was all really, the announcement was all really rolled up with this idea of limiting relief on investments as opposed to kind of true family businesses. Strangely, 50% relief continues to be available on AIM shares, which was the sort of main focus of that policy announcement. I think that was probably fear of shockwaves through the market more than anything. So how long that lasts, we don't know. But for the time being, £1 million cap on family businesses, and then 50% relief beyond that cap. I think we've got one more slide.
Yeah,
we have pensions. So another announcement from the budget. This one doesn't bite until April 2027, so we're still a couple of years away. We've had some consultation documents on it. They're very much about the how, not about the should we do it. So every sign that the government wants to press ahead with introducing these changes, it's just some technical questions about how do we deal with the administration, how do we deal with the reporting, how do we get the legislation right. The headline of the change is that from 2027, pensions are going to be brought within the scope of inheritance tax. Up until now, they've been outside the scope of inheritance tax, and since 2015, they've been pretty much free of any kind of tax charge on death. The sting in the tail of this is there'll be an inheritance tax charge on your pension pot when you die, but there could also then be an income tax charge on your successors when they access that pension. And that's going to largely depend on how old you are when you die. Do you die when you're under 75? Do you die when you're over 75? If you're paying an inheritance tax charge and an income tax charge, you can very quickly, very easily get to a kind of 67% effective tax rate, and maybe even higher than that. If your pension scheme rules are such that on death, the pension fund comes to an end and they want to pay out death benefits within a couple of years, you might not have a whole lot of choice about when your successors access that pension. They might just be forced to take that value within the 2 years and suffer the income tax charge without a lot of choice. So really quite draconian, quite penal tax charges. We're already seeing some significant changes in taxpayer behaviour, people who've been leaving their pensions alone, having to revisit those plans, people thinking about how best to deal with sizable pension funds, especially people who are already above age 75. Again, one or two, it seems too generous to call them easy wins, but things like if you die before April 2027 and let your pension pass to a surviving spouse, that might be a bit of a missed opportunity, because you might have had an IHT-free succession before 2027, and your spouse might then have an IHT charged succession after April 2027. So people thinking about their nominations, thinking about their attitude to pensions, their behaviours in terms of accessing, and really a sort of a joined up thought process about their inheritance tax, their succession, their funding of their retirement, and how they're going to do that, where they're going to take their income from, and what makes the most sense. I think the other really big headline on this is, I've lost count. I would have no chance of counting over the years how many people I've spoken to about possible inheritance tax, to say you don't have an inheritance tax problem, and a big part of that decision is because the pension was inheritance tax free. There's a whole chunk of kind of middle England that when you bring that pension fund into inheritance tax, they suddenly now do have an inheritance tax problem, and it might really pay them to just be thinking forward about that, thinking about whether they can do something to improve that situation. So no silver bullets, but a very strong encouragement to go and have a look at this and take it seriously. And I think that's the last slide.
That isn't the last slide. I think it's one more on pensions. But just to clarify that, Graham, I'm guessing it's talking to your personal tax advisor, your financial advisor.
Yeah.
And also thinking what you've got in your will as well.
Yeah. So very much that sort of holy trinity of getting the advisors, talking to the advisors, maybe having the advisors talking to each other to make sure they're operating a joined up approach. You don't want people kind of doing things in a vacuum and then someone else over there doing something different in a vacuum. That's not going to work.
So I think this is some of the stuff you already spoken through.
Yeah. Yes. Sorry, I thought the slide had been shortened, but
no, we will be sharing a recording of this, so if you do need to read through the slide, it's there. But I think Graham's pretty much spoken through all of that anyway. We've answered questions as we've gone along, but if there's any other questions that are coming through, please feel free to pop them in the Q&A, and I'll make sure these get answered. Actually think one has come through. Another one. Okay, so in terms of AIM shares, I think I'm going to direct to you, Graham. Do you really think they'll come further after AIM shares when they offer a genuine case for providing employment and tax revenue to the government? So to add context, this particular person's got a situation where they seem to have missed that asset managers are manipulating business relief rules by setting up developers, finance companies, or companies leasing ambulances to the NHS that employ hardly anyone. Hang on, I'm just trying to understand.
I can see it as well, if that helps.
You can see it as well.
Yeah. In a word, yes, I think they probably will. I think maybe not in the short term, but I think it's very hard to justify why investments in AIM shares benefited from relief in a way that investments in bigger companies didn't. It was always an outlier of business property relief as to why it qualified. I totally agree that all the talk seems to be about getting business property relief with AIM shares, whereas there are companies out there that have been there for a long time using these money lending businesses, these LLPs often, as BPR structures. We haven't had any legislation on this at all. All we've had is the sort of the tax impact notes and the sort of policy explanations. I think when the legislation comes, it's going to be really interesting to see how they try and target this at the right place. So it will undoubtedly be trying to limit relief away from pure investors and trying to save relief for genuine family-owned businesses, kind of owner-managed businesses, and that type of thing. I think getting the wording right there is going to be quite tricky, and there are going to be some difficulties in maybe leaving loopholes behind if they're not careful, or going the other way and denying relief to people that really probably ought to benefit from it, but find themselves barred. So yeah, lots of unanswered questions. See what the legislation looks like when we get it, and I would guess we'll get it. I would hope at the autumn budget this year. I'd hope we get some draft legislation then. I'm hoping they don't leave it until autumn 2026 with an April 2027 start date, because it will be too late to fix any problems by then.
Okay, great. Thanks very much, Graham. If you have any other questions or anything, please feel free to pop them in the Q&A. We now have a short poll that we'll just ask people to answer if that's possible. I think I'd like to say a huge thank you to the panelists that have been on this webinar today. I hope everyone's got an insight into what's happening and what's planned to happen in the coming months and years to come. I think just as a reminder on one of the things that's cropped up a couple of times with Felix and Graham is the level of compliance that's come into play in the next couple of years, in the next few years. And I think it's important to know that we do things like tax investigation insurance. So I'd recommend making sure that you've got that in place with your current accountant. So if you do have any investigations that are coming up, you've got your accountants by your side that can support you and, you know, answer HMRC's inquiries and sort of hold your hand through that whole investigation as well. So we've got quite a few answers that come in from the poll. So thank you very much for everyone who's answering on that. If you do need to have any other questions or anything, please feel free to contact your TC relationship manager, or feel free to contact either Wendy, Felix or Graham. I'm sure they'll be happy to answer any of your questions. You can connect with them on LinkedIn, or you can find their contact details on our website, or just send a general inquiry through on our website as well. As I mentioned, we will send out recording, so if there's any information you want to recap or you want to watch the whole thing again, you can. Like I said, I hope you, if you've got any questions, please feel free to drop them in and contact the people that are on this panel. So that's a wrap, I think, for today. Thank you very much to our panelists who have been really super helpful today. Thank you for you for spending your time today in terms of finding out a bit more information about this stuff. And enjoy the rest of your day.